The life cycle framework and related valuation model is widely used by large money management firms worldwide. Let's understand why. I have a fair amount of practical knowledge about the needs of users of financial statements whose main purpose is to judge the plausibility of forecasts for a firm or one of its business units. Basically, we need to understand if the business has created or dissipated value in the past and what is a key issue for creating value in the future. A forecast is plausible if it represents a skill level that has been demonstrated in the past and if it makes sense compared to the skill levels of competitors. The life cycle framework makes economic sense and is intuitive to business people. It displays stages of the life cycle of firms and illustrates the interplay of skill and competition over time. The solid line on the chart represents the firm's economic returns. Think of this as a return on invested capital with accounting biases minimized. The dashed line represents the firm's reinvestment rates. The red horizontal line represents the long-term cost of capital. On the far left, if a firm in its early years successfully innovates, then it can earn economic returns well above the cost of capital and create even more value if accompanied by high reinvestment rates. In those early years, management's top priority is to confirm or disconfirm as quickly as possible the key business model assumptions and adapt accordingly. At the competitive fade stage, management needs to build or acquire new capabilities that deliver innovative customer solutions and not be satisfied with its existing competitive advantage. At the mature stage, management faces a tough task. They must continually improve efficiency of existing operations while developing new businesses capable of earning more than the cost of capital. The hallmark of the failing business model stage is complacency and a belief that the future will mirror the past. Restructuring of the firm and purging its dysfunctional culture is needed. Here is a life cycle track record covering 2000 to 2020 for Intuitive Surgical. In 2001, the FDA approved Intuitive Surgical's Da Vinci robotic surgical system for prostate surgeries. Today, Intuitive Surgical is a global leader in robotic-assisted, minimally invasive surgery. Long-term shareholders earn exceptionally high investor returns rooted in knowledge-building proficiency that produced highly favorable experiences for patients and surgeons. The life cycle track record has three parts. The top panel displays a firm's economic returns calculated as CFROIs, cash flow return on investment, which are real, inflation-adjusted, and more accurate than conventional ROIC, return on invested capital. The benchmark real cost of capital is displayed as a horizontal red line at 6%. Real asset growth rates are displayed in the middle panel. The bottom panel displays a relative wealth index, which is a stock's total shareholder return versus the S&P 500 index. The top panel indicates that in the early 2000s marked the startup high innovation stage for Intuitive Surgical. The subsequent high CFROIs avoided the customary fade towards the cost of capital due to the firm's knowledge-building proficiency. This was accompanied by high real asset growth rates. Over many years, the firm delivered the life cycle performance that exceeded investor expectations, resulting in shareholder returns in excess of the general market, as shown in the bottom panel, which shows a rising relative wealth index due to Intuitive Surgical's stock sharply outperforming the S&P 500, especially in the early years. Here is a takeaway. Boards of directors and investors benefit from placing forecasts of future life cycle performance scenarios in the context of a firm's or a business unit's past life cycle track record and the track records of competitors.